Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And largely we are in a very similar market to where we were over the past couple of weeks, where markets are somewhat overbought, a little overextended, but we're still seeing a fairly healthy market rally here. So the question for many investors is, where do we go next? Are we set for a correction here? So I want to take a look at the markets and help answer those questions. Now, before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off, as we normally do, taking a look at the major indices and see where they currently sit. We'll take a look at sector rotation and what that data is currently showing us regarding the health of the market rally. The fixed income markets have seen some interesting moves, and the question is whether those trends will continue or they will more likely roll over in the trends that they were in over the past few months. We'll take a look at the chart data for that. Then we'll take a look at economic data, which is really the one thing that I think is concerning a lot of investors right now, is some of the inflation numbers, inflationary concerns that's going to have ramifications for both equities and fixed income markets, before we share with you some of our ideas and open this up for Q&A at the very end if we have a few minutes. But the primary question that I want to help investors answer for today is a question that we've been getting a lot over the past couple of days regarding, are markets due for a short-term correction, especially when we started to see some of the higher beta names, the tech names, start to sell off as some of the numbers came in not as strong as expected, or perhaps the growth numbers not as strong as expected. But largely, I would say this particular earnings season has been a fairly strong one, across the board. We've seen some substantial beats to the upside. We've seen more stocks that have actually outperformed than we saw last quarter. So things are looking fairly strong, and when we look at the earnings season. So my name is Tony Zhang. I'm the chief strategist here at Options Play. And I want to share with you my technical charts, our economic research, and just how we're looking at the broader markets to answer our first question is, are markets due for a short-term correction? So before we look at any specific charts, just taking a look at the earnings week or the earnings calendar this particular week, it's a very packed one. You have some big ones that reported here this morning, and some big ones that are coming up today. I would say Alphabet is probably the big one that you have. Alphabet and Microsoft later today. You have Starbucks, also a big one, reporting later today. Tomorrow you have Apple, you have Facebook tomorrow that are reporting, and then on Thursday you have Amazon. You have McDonald's, you have some, also Boeing tomorrow morning. So you have some pretty big names all reporting this week. I think close to about 50% of the NASDAQ 100 is reporting this week, and something like 25% of the S&P 500 is reporting this week. So, when you look at some of these names, most of these mega cap tech names have not outperformed in terms of a stock after earnings over the past couple of quarters. So largely that is similar what we expect this particular week, but we have seen some significant beats that have outperformed. NXPI has outperformed. Tesla underperformed yesterday. So, when we look at this across the board, we see a pretty wide dispersion of stocks that beat and miss, and stocks that have outperformed and stocks that have underperformed. The main theme that we have seen carry over from last quarter was when you look at the price action here from the banks. Banks that beat heavily on earnings and revenue actually underperformed in terms of a stock price. Largely, I expect many of the mega cap tech names to have similar type price action, where they will actually report fairly strong numbers, but the stock may not move substantially higher. We saw that out of Tesla. We saw that out of Netflix. We saw this, in my opinion, out of some of the big tech names that will report here this week. But when we have to look at, I think, the smaller names, the value names, if you're looking for outperformance, that's where I think you need to look. So when we look at the S&P 500, clear, strong uptrend on the weekly chart. On the daily chart, we've seen a few pullbacks here to the downside, but now a substantial move to the upside around above that $400 level, all the way up to 417, 418. We've rallied up to that level, pulled back slightly, and is now revisiting that 418 all-time high. And the question is just the fact that since we've been above the 21-day moving average for almost a month now, are we due for a correction? Because typically we see moves above the 21-day moving average go for a period of time before they pull back at least to the 21-day moving average. So this is really where we want to pay attention to the broader markets. This all-time high so far is looking fairly constructive for a continuation higher, especially if these tech names can outperform. But that's really where we want to take a look at the broader picture here, because when you look at the NASDAQ 100 index, you have this double top forming here. And the question is whether these tech names, the 50% of the NASDAQ 100, is going to perhaps slightly underperform and perhaps pull back here to the 21-day moving average. And then looking at the S&P 500 so far, looking stronger than the NASDAQ 100 if you look at relative strength. But the one place that I do want to point to where it does look fairly constructive here is IWM Small Caps. After kind of sitting sideways here largely for about the last 2.5 months or so, small caps starting to break out here to the upside. So I think small caps is more likely to rally here and maybe outperform the mega cap names, especially those mega cap names that are all reporting here this week. We may see some underperformance for some of those shares going forward. So as we look at the spectrum of the major markets, it actually seems that small caps has the higher chance of outperforming here versus the S&P and the NASDAQ this particular week. But if we look at the S&P 500 market breadth, this is the RSP, which is the equal weight S&P 500 index. It is making new all-time highs while the S&P 500 market cap index is just back at all-time highs. So what this is telling me is that the broader S&P 500 names are actually outperforming the mega cap names. And this is something that we've seen for quite some time now, where the RSP has outperformed the SPY, the market cap indices. And this is, when you look at this type of data, this is constructive for the market rally that we are currently in. And this is something that we want to make sure that you understand, because when we see that the broader markets are rallying, actually stronger than the mega cap names, that is signs of a healthy market rally. So, when we see this type of market, this is less concerning about a major correction. This is less concerning that we're going to see a correction here in the broader markets. It actually provides evidence that the market rally that we're currently in is relatively healthy and can continue to move higher here, despite the fact that we are overbought. So that's a very important metric to pay attention to. And then we have to look at value versus growth. We see that value, and this is a chart for those of you that have been following me for quite some time. This is something we've been following for quite a few months here. Value has underperformed growth for multiple years now, but over the past 6 or 7 months, we've put in this major bottoming formation and has actually started to outperform. Value has started to outperform growth. Now, we've seen some declines here over the past few weeks, but so far it is holding this breakout level. It's holding this breakout level now as support. So this, from a risk to reward perspective, certainly favors looking at value outperforming growth, which lines up with the technical charts that we were just showing you, where the mega cap S&P, NASDAQ 100, near all-time highs, near overbought conditions, probably has less room to move to the upside than IWM, small caps, value stocks that have started to break out here to the upside after consolidating and basing for the last 2 months or so. So these charts really line up well. So as you look for opportunities for bullish equities here going forward, moving smaller into the cap spectrum, moving lower in terms of to the value spectrum, that's really where we think outperformance will be here over the next few weeks. So when we look at the 10-year yield, this is something that has seen some substantial expansion to the upside over the past few months. And now we've had a pretty I would say, significant consolidation period in 10-year yields to about that 155 basis point level, which also corresponds with a 382 fib retracement level. So 155 was the 31.8% fib retracement level. So far, that's come back to retest that level as support and holding at 155 basis points. So risk to reward ratios certainly favor potentially yields starting to rise here again. Now, this rise, in my opinion, will likely be a slower rise, but certainly we seemingly have found a bit of an equilibrium here for yields around 155 to 175 here to the upside. And we're really looking for a breakout here above 175 before yields can continue to move significantly higher. And when we look at the bond market, this is really where those two, the fact that yields have stabilized, and if we look at the bond market, things certainly seemingly line up here. We have TLT, the 20-year or the long-dated bond ETF, retracing, in this particular case, 618. So 61.8% of the total move from 2018 to the 2020 highs prior to the pandemic. We've retraced 61.8% of that move. And now we've had a little bit of a bounce here. And the question is whether this bounce is now a continuation back into a bullish trend here for TLT. Now, when we look at this trend overall, it is very much a downtrend, very much a bearish trend that actually broke this downtrend channel. So we had a very clear channel here to the downside, broke out to the downside, and now we're revisiting this channel here as resistance. And the question is whether this can break back into the channel or this is likely going to continue lower here. So this is a pretty classic, I would say, continuation pattern here where you see a strong downtrend followed by a period of consolidation. And when you do get a breakout here, we can see a pretty large projection here to the downside. It hasn't broken yet, but this is something that I think is worth paying attention to. This continuation pattern here could continue for a little bit longer. We don't have a strong catalyst, or we certainly don't have a breakdown just yet. But this is one to watch out, because if you do see a breakdown here below this resistance level, and we're certainly, sort of closing in on what would be, a very clear support channel, now acting potentially as resistance, that could be the catalyst that we see that drives TLT significantly lower into the high 120s, back perhaps even as low as 124 here to the downside. So this is very, very important to pay attention to, which largely lines up with some of the inflation expectations that are concerning investors. That I'll show you some of the economic numbers behind. And if we look at investment grade, same thing. We see a strong downtrend. We've seen a significant downtrend here in investment grade after a multi-year rally here in LQD. And so far, as you can see, 134, which has been a major resistance support level here for LQD, any rallies here have failed to get back up to that 134. It still can get up there. There's not to say that it can't, but we're starting to see a bit of a double top forming here around 133, 132, and the question is whether this can break out here to the upside. But it seemingly is starting to lose a little bit of momentum here on this rally. And the question is whether this will start to roll over. And that's some concerning views here from fixed income and HYG. So we're moving along the risk cap. You have treasuries, the riskless assets, LQD, which is a little riskier, but still an investment grade. And now we're in high yield, the riskiest part of a fixed income. If we start to see this roll over, that's really where we start to see some concerns. Now, HYG so far holding up, as you can see, still actually trending higher compared to LQD and TLT. But it has failed to break out higher here from this $87, $88 high here. And on rallies, starting to lose some momentum. As you can see, RSI is starting to roll over here and potentially move here to the downside. So nothing concerning just yet, but these are warning signals that we need to start paying attention to from the fixed income markets. Now, when we take a look at sector rotation, this is something that we started to see sector rotation. We started to see a lack of sector rotation the first couple of weeks of April, but as we move towards the back end of April, we have seen some pretty significant rotation that is, again, healthy for a market rally. When you see a few sectors dragging the markets higher while the rest of the sectors are lagging behind, those are the signs of a potential correction, or those are the signs of a market top. We started to see those in the beginning of April, where technology and consumer discretionary were the only two sectors moving higher. Now, we have seen that stop. We have seen a fair amount of sector rotation since then. As we can see, both consumer discretionary and technology are no longer in the leading category. They are now weakening and moving down. And then we have real estate, utilities, healthcare, and materials all moving in the right direction towards this leading category. So this type of sector rotation is healthy. When you see sector rotation, that is good for the overall market. And then you have this energy, the stealth rally here that energy has been on here over the past couple of weeks here as it starts to get back into the improving category. And then you have industrials, consumer staples, and communications continuing to lag behind and being in the weaker category. So the interesting thing for me is the bifurcation we've started to see between industrials and materials. Industrials actually in the lagging category, while materials in the leading category. You know, materials and industrials have been moving hand in hand, but it certainly seems like materials is gaining the upper hand here. So as you're looking for opportunities here, real estate, utilities, certainly one place to look at. Healthcare and materials, also one place to look at. And for those of you that are interested in energy, in my opinion, energy may have some upside from inflationary concerns on, inflationary concerns and just seeing oil prices spike as a result of that, but also financials, especially as we start to see yields perhaps stabilize and maybe start to climb a little. Financial is also another one to pay attention to here. So when you're looking for specific opportunities in the market, that's how you want to look at the broader sectors. So looking at the economic numbers, again, manufacturing continuing to surprise us to the upside. Manufacturing and services both continuing to surprise to the upside. In my opinion, actually, the services side is more important for the economic recovery because manufacturing has been pretty strong here since late last year. I would say August, September, we've seen manufacturing become extremely strong. It was services that was lagging behind up until January, February of this year, but we've seen services come back, roaring back to life, and that is the economic evidence that the economic recovery is taking shape, that the vaccinations are working, that restaurants, bars, travel and hospitality, that's where you want to see the biggest gains in terms of employment. We are seeing that. But the one thing that we are starting to be more concerned about now is on the manufacturing side, despite being very strong, the prices that manufacturing companies need to pay for raw materials is becoming increasingly a problem here. This is inflationary concerns, whether this is raw materials that are being delayed or restricted because of the supply chain that we have, supply chains that are being disrupted by COVID, supply chains being disrupted by a lack of manufacturing capacity here in the US. This is going to drive some interesting trends here for the next couple of years with respect to onshoring, the infrastructure spending that Biden wants to put through, and reshoring, meaning bringing manufacturing back to the U.S. so that the supply chain is not being disrupted by pandemics like by COVID-19. But in the short run, raw materials and also labor, wage inflation is a huge concern right now. We have a wage shortage due to the unemployment benefits here in the U.S. We have a wage shortage based on the number of people that perhaps are capable of going back to work, because moms that have to stay at home with their children because they are not back in school can't go back to work. There are multiple wage constraints that right now that we have that are going to put a huge pressure on employee-heavy based companies. They're going to find it harder and harder to find employees. They're going to have to pay employees substantially higher to bring them on board. And those are things that are going to be passed on to consumers when we talk about consumer goods. So especially if you look at the S&P 500 recently on earnings calls, this is the spike that we have seen in terms of number of S&P 500s mentioning inflation on an earnings call. Usually this is in the 4 to 5% range as the high end. Recently, we've seen this go up to 12%. So this is that sell-off that we're talking about in TLT that's concerning, that this will potentially likely to continue. That's going to put some downside pressure here on bonds. That's going to rise potentially rates. That may put also a cap here on equity valuations here as well, as if rates continue to rise. You know, there are some segments of the market that will benefit from this rise in inflation. Everything from more on the industrial side, whether it's the industrial companies that are more sensitive to inflation, such as John Deere, Caterpillar, that are going to benefit from industrialized companies like mining companies that are going to buy those equipment, everything from food production in terms of agriculture, energy prices, gold and precious metals and base metal mining. So there are plenty of types of sectors and companies that will benefit from higher inflation, but there will also be plenty of companies that will be hurt quite heavily by that. So as you invest going forward, be very, very mindful of these concerns. So looking at some of the opportunities here in the broader markets, the first one I want to bring up is an industrial company that is sensitive to inflations that will likely benefit from rising inflation. So as you know, precious metals and gold and base metals start to rise as a result of inflation, you know, mining companies like Newmont Mining are going to benefit from that. So we've seen Newmont Mining, after a strong move here to the upside, spend multiple months consolidating, and over the past couple of weeks started to break out here to the upside. We had the breakout. We're starting to get a bit of a pause to that breakout, and that is the opportunity that I see here to the upside for names like Newmont Mining and some of the gold miners that have started to do fairly well. And then we have CVS. This is a healthcare stock, and I was showing you how healthcare is starting to outperform here. And CVS has underperformed not only the healthcare market, but the broader market for multiple years. But it has started to stem that underperformance. As you can see, it started to break out above this multi-year bearish trend line, and is now continuing to push this higher bound of this resistance level, and it continues to push this upper bound while making higher highs. So we have this triangle starting to form, which is the potential breakout here that we have here for a name like CVS that has largely underperformed the broader markets in the healthcare market. We've seen Walgreens start to outperform here. CVS also chart patterns looking fairly bullish here for a potential breakout. Another one that's reporting this week. So we've seen a lot of these tech names that have underperformed here. But the one that really stands out for me is Pinterest. And for those of you that have followed me for a while, I've been bullish on Snapchat quite a bit over the past few quarters, specifically this quarter and this quarter. Now, this is Pinterest, but Pinterest has been a strong performance right on the back of Snapchat's strong performance here. Now, Snapchat did not have a particularly strong quarter, but this is one where I start to see some benefits where I think Pinterest will actually outperform Snapchat this particular quarter. Pinterest does report earnings later this week. So this is one of the few tech names that I am paying attention to here this week with respect to earnings, that I do think out of the social media platforms, with the exception of Google and Facebook, I think Pinterest will likely be an outperformer here. And lastly, looking at the aerospace section, this is really where Boeing, despite having a decent few quarters, have really started to lose some momentum here. As you can see, after these big moves to the upside, they tend to underperform here. And the fact that Boeing, after breaking out above this 240 level, has failed to hold on to these levels and started to break lower below these support levels, that's concerning to me, that Boeing is starting to lose ground. It's losing relative strength to this sector, the industrial sector, and is now starting to drag the sector lower here. So from my perspective, Boeing, especially if you look at the order book, the concerns that we're starting to continue to see with the 737 MAX, 777X delays, the entire order book continues to actually look worse here for Boeing. And remember, even though we're quite bullish on the aerospace and airline industry, Boeing is not exactly the same. Those are two different markets, all right? Boeing makes money from selling planes. Their space contracts are not doing particularly well compared to some of the new entrants in SpaceX and other private companies. So this is really where we're starting to see Boeing lose relative strength. So these are some of the concerns that I have here for Boeing going forward. So with that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you an understanding as to, at the high level, the health of the market rally, which sectors are strong, and what concerns that we see going forward. And despite that, where we see some opportunities here in the markets, especially with earnings coming up this week. So with that, thank you so much. I hope that this helps you start your week, and I hope you guys have a great trading day. Thank you so much, and I'll see you guys here next week.